You're flying back to Indianapolis after this? Is that pretty much it?
4 o'clock flight.
Still based there after so many years?
Still based in Indy.
Yeah.
And proud we've got a nonstop flight between Indy and San Francisco. That was really key.
Yeah.
I actually had an opportunity to play a role in putting that flight together.
Yeah.
Yeah, and as silly as it might sound, connectivity and nonstop flights from Indy to San Francisco are super important. Actually, poor Rory, he had to spend years, taking red eyes and tough connections and sleeping in O'Hare Airport. And then literally after we sold the sales forces right when we got the nonstop flight in place. So he really never got to enjoy the benefits of it.
No, but that makes sense. It is pretty rare, to build such a big company, a tech company in particular, outside of Silicon Valley. And ExactTarget ended up being like $2.5 billion or something like that, right?
Yeah,
so
that was a great exit for us. It was incredible.
And how many employees did you have at that time?
We had about 2,000 employees at the time of the acquisition.
Oh, that's great.
All around the world. About 1,500 were Indianapolis based. So it felt really good, actually, to be, kind of a big fish in a small tech pond and feel like you made a difference. We really made a difference in the trajectory of our city and in downtown, in the urban core, and then the overall tech community. So that's been very fun to see, and actually very rewarding that Salesforce continues to invest in Indianapolis. And in fact, the largest building in downtown Indy is called the Chase Tower. Mm-hmm. It's going to be rebranded the Salesforce Tower.
Nice.
So that'll be a neat legacy and really good for the tech community.
Yeah. Mark is putting Salesforce towers everywhere now.
Yes. Salesforce is all about the towers. So we're going to have our own in Indianapolis, which is pretty neat.
But before you sold to Salesforce, you actually went public, and before you went public, actually a ton of stuff happened that you were aware of scale because we were close to ExactTarget. But that I really wanted to talk to you about, because I think a lot of entrepreneurs they get into doing a particular company for passion or for whatever reason, and they don't really think about the later stages, and people don't talk about it as much. But at ExactTarget, you had a pretty unique kind of last few years, last few quarters, and I kind of really wanted to dig into that because so much stuff happened that's interesting, from equity markets to the IPO window to how your valuation works to growing. And let's start, kind of talking about it. One of the things that people always tell me about you and ExactTarget was that you were so capital efficient.
Right.
And so, what does that mean, and how did you kind of think about that?
Sure. So, we started ExactTarget in early 2001. 3 first-time software entrepreneurs. Really, none of us had a technical background, and we raised a small round of capital, from friends and family, and then later an angel round. And we just had to be remarkably resourceful. So we built a simple product. We sold very aggressively. We partnered with customers, and in many ways, customers ended up funding the business for us. What was really quite interesting is that our first IPO window that we felt we could take advantage of was late 2007, and we actually filed on the NASDAQ December of 2007, and at that point we had only raised $6 million in capital, and we still had 4.5 on the balance sheet. It was extraordinary. And in 2007 we were finishing the year at $48 million in GAAP revenue. Mm-hmm. And then we rolled into 2008 and we grew 50% and finished 2008 at about $72 million in GAAP revenue, and we'd only raised $6 million in capital. So we were remarkably capital efficient up to that point.
Right. It's completely unheard of in today's kind of market where people raise hundreds of millions of dollars. All the unicorns have tons of debt, and this is kind of very unique.
We were very frugal. We also took advantage of our region. Indianapolis is a very affordable market to grow a business, to live. We recruited very aggressively across all these amazing universities that were within an hour and a half of downtown Indy. IU, Purdue, Notre Dame, Butler. So we attracted a lot of talent, built the business on a much lower cost structure than our competitors. Our competitors were largely East Coast and West Coast based, so we had a cost advantage. And then we were very frugal. One of our core values was, spend money like it's your own. And we really instilled this idea that we were going to be frugal and smart with where we made investments.
Right. Do you think that was the right thing to do, right? I mean, it seems like you kind of had to do it because of the history of your company, but if you had to do it again, even at that time, in that era, do you feel like, we should have, actually raised a lot more money, be much more aggressive about growth, even move the company if necessary to be able to do that? Or, what's the advice you would give on that?
Well, I think for us it worked out great. And part of the reason it worked out great is we really had so much to learn. We were really first-time entrepreneurs, so we had a lot to learn, and I think if we had raised too much capital too soon, we probably wouldn't have spent it in the right places. Right. So that forced resourcefulness, it forced prioritization, and as we became more mature as leaders in the company, then we got a lot smarter about how to double down and make big investments. But for us, starting in a very capital-efficient way and starting small was the right thing to do. I think it's different for every entrepreneur. I think it's based on the market opportunity, your experience set, maybe even the region in which you're coming from. But there's nothing like building really strong unit economics and then raising money, not when you need to, but when you want to, and when you know you can go a lot faster. Like you have you have product market fit, you have unit economics dialed in, and you've got a degree of confidence that you can pour a lot more capital on the business and good things are going to happen. And that's really what happened to us. That was our next chapter, and a great lesson for us in just resilience and determination. So we stayed on file all of '08, and it was so difficult. I like to describe it that we had all the burden of a public company with none of the benefits.
Right.
We had really hoped that going public would not only give us an infusion of capital, but it would create more of a brand that was enterprise oriented. Because up till that point, we'd really been selling just small and medium-sized businesses. We were starting to get a taste of how our product could apply to the enterprise, but we were a little-known company, thinly capitalized in Indianapolis, so we really felt like going public would be meaningful. And the window had been open for small to mid-sized SaaS companies to go public. All of a sudden, the window closed very dramatically in '08, yet we had to act and behave like a public company, and this was before the Jobs Act. So every quarter, we had to meet with the analysts that were going to be covering our stock. We had to set expectations. We had to report financials. So we had a lot of that burden through all of 2008, and then it just became apparent it wasn't going to happen.
Right.
No software companies were going public, and certainly little tiny ExactTarget from Indianapolis wasn't going to be the first to crack the market back open.
Right.
In early '09, we started being approached by late-stage tech investors, and we're so fortunate to bring scale and battery and then later TCV into the business. And that was a time when it became a lot more evident that it was time to put our foot on the gas and really go for growth.
That makes sense. But maybe a couple of things to unpack here, right? Right now, especially as you said with the Jobs Act, like the process of doing an IPO seems instantaneous from the outside, right? You just all of a sudden people go public and the S1 is there, but that's because you can file the S1 advance, kind of do it secretly and kind of work with bankers to kind of get everything lined up correctly. But once you start to do that, you have to think very carefully. There's a silent period. You can't really talk too much about financials, and you have all this reporting to do.
That's a good point, because all of '08, we were actually in the quiet period. So imagine our poor head of marketing. We hired this fabulous guy, Tim Kopp, to be CMO. In his first 12 to 15 months, he was all stuck in a quiet period. That's challenging.
Yeah, because that's considered market manipulation.
Right, absolutely.
Marketing. Yeah, no, it's kind of crazy. And then the other thing, of course, is the IPO window. And people say that quite a bit. But so what does that mean to you, like the IPO window being open or being closed?
Sure. I think two things come to mind. One, you have to pick timing where the market is really receptive, to software IPOs, and some of that's just kind of good luck and fortune. You want to build a business that you're ready to go when the window and the opportunity presents itself. So in our case, we thought the window was there in late '07. It wasn't, and thankfully, it was kind of the best thing that ever happened. Best thing that ever happened to us. One of the benefits we really gained by getting a taste of what it was like to be a public company without having gone public, and then also bringing great investors on board in early '09, is we started to refine our thinking about what we wanted the characteristics of our business to look like when we went public. And we later went public in March of 2012, so we actually gave ourselves another 3 years to make the right investments to roll into the public market with a ton of momentum. Now, I'll give you a couple examples. What we really learned from being on file in '08 is that almost regardless of where your margin is, the street wants to see margin improvement. So you really have to be thoughtful about when you go public, what's your path to margin improvement? And we were actually profitable in '07, '08. It would have been remarkably difficult for us to improve the margin without starving the business. So as we started to think about that 3-year horizon that we planned for, in '09, we started turbo investing in the business. We got a lot more aggressive with R&D. We started expanding internationally. We built a lot more sales distribution. And sales distribution in particular often takes 12, 18, 24 months to really pay off. So we made sure that we front-loaded our investment. So we rolled into the public markets. We had accelerating growth rates. And we built a sales team large enough to really become the dominant market leader.
Right.
I find a lot of companies that go public without that forethought. Maybe they haven't been making the investments over the prior 12, 18, 24 months. They get public and then they get handcuffed. They can't be aggressive with investments. And as a result, they kind of stymie their growth. And then as we all know, once a SaaS company stops growing, you get put in the penalty box in the public market. It's almost impossible to work your way out of it.
Right, that makes sense. And IPO is not like the end, right? You have to really think
absolutely.
It's just another round of funding in a lot of ways, right?
That's right.
And so you have to think about not just the quarters before the IPO so you can IPO, but also the quarters after and keep the growth going. That seems to be something that is really critical in the day and age.
We actually had great advice from our bankers and from our board that we really needed tremendous clarity into, let's say, the first 6 quarters after we went public, because certainly the benefit of SaaS is recurring predictable revenue, so you have to have that dialed in, but you also want to have a sense that you've made the right investments in product and sales that you've got a pretty high degree of confidence that your growth rate is still going to be, humming along at a really attractive rate.
That makes sense. And then, what would you say now is the difference between doing an IPO and raising like an equity round, or one of those later stages rounds of some sort? What's the difference?
Well, certainly if you raise money privately, you give yourself a lot more degree of freedom to invest and figure things out. The public benefits are tremendous. For us, we ended up going public on the New York Stock Exchange. It was a huge springboard for us as we moved up into the enterprise space. We loved it. But you really only want to do it, I think, when you really feel like you have the business dialed in, you understand your metrics, and you really do have that very good visibility in the business. If there's still a lot that's not working, you're trying to figure it out, you're far better to do that as a private company. And the nice thing is there's a lot of late stage capital sources today, so you don't have to go public to raise meaningful capital in this market.
Right, and we see that with quite a few of the unicorns, so to speak, that it's
absolutely.
Really
I feel like in many cases they're staying private a lot longer than what we may have seen in the past.
Yeah, that makes a lot of sense. Yeah. Thanks a lot.
Okay, super. Thank you.